Notice. I am Shivakumar Lachapeta, a certified equity research analyst, stock market investor and F&O trader with more than 5 years of experience in the stock markets. Similar to the earlier videos, this video is also for beginners in the stock markets and for people who want to know about stock market investments. In the previous video, we discussed 4 most important ratios for analyzing a stock. If you missed that video, please watch it and come to this. You can find the link in the description or topmost right corner. In this video, we will learn about next 4 parameters for analyzing a stock. Number 5. Return on equity or ROE. Number 6. Interest coverage ratio. Number 7. EV by EBITDA. Number 8. Dividend yield. Note, whatever information I am providing in this video is only for education purpose and should not be considered as an investment advice. Make sure you consult a financial advisor before making investments in the stock markets. Let us get into the topic. The next 4 important parameters for analyzing a stock. Return on equity. We have already learned that equity equal to total assets of the company minus total liabilities of the company. Therefore, it is very simple to understand the term return on equity. It means net income divided by equity or net worth. It is denoted in terms of percentage. I will repeat the definition again. Return on equity means net income divided by equity or net worth. ROE or return on equity indicates how efficiently a company's management is using its net assets to generate profits. In layman's terms, it is the returns achieved by the company on the invested assets after paying out all loans, dues and debt. For a good company, ROE shall be more than 15%, but it varies among the different sectors and industries. The higher the value of ROE, the better the company is generating profits. It does not mean when we find a share with high ROE, we can buy it at whatever the price it is trading at. Make sure to analyze further on other parameters as well. Next one. Interest coverage ratio. Companies take loans from financial institutions like banks, NBFCs and other corporations. They issue bonds for raising capital to expand their business or for other purpose like to meet their expenses when they face losses. All of this comes under debt. We all know that anyone who takes loans should pay interest on that as well. Interest coverage ratio is earnings made by the company before taxes divided by interest paid by the company on their debt. I will repeat the definition again. Interest coverage ratio is earnings made by the company before taxes divided by interest paid by the company on their debt. It is similar to the portion of money paid by a person as EMIs or any interest on borrowings from his net income every year. So it is obvious from the definition that if interest coverage ratio is high, then financial health of the company is good. It is better to look for the shares of a company with interest coverage ratio greater than or equal to 5. Next one, EV by EBITDA. EV by EBITDA means enterprise value of a company divided by earnings before tax, depreciation and amortization. I will repeat the definition again. EV by EBITDA is a ratio. It means enterprise value of a company divided by earnings before tax, depreciation and amortization. I know it sounds scary, but do not worry. We do not have to learn accounting, just bear with me. Many websites provide this information for free. I follow the website www.screener.in for this kind of information. We can set whatever parameters we want for analyzing a stock in this website. I will show you how to do that in some other video. Coming back. The enterprise value of the company is the measurement of its total business value. It is equal to market capitalization plus debt minus cash and cash equivalents. We'll repeat the definition again. Enterprise value of the company is the measurement of its total business value. It is equal to market capitalization of the company plus its debt minus cash and cash equivalents. So you might ask me, what exactly is market capitalization now? Market capitalization is the total monetary value of the company. It means if you want to buy 100% of that company, this is the money we need to pay. Market capitalization is the total monetary value of the company. It means if we want to buy 100% of the company, it is the money we need to pay for that. EV by EBITDA means enterprise value of the company divided by EBITDA. To make it simple, choose the stocks with values lesser than or equal to its competitors' values. Last one, dividend yield. Companies pay some portion of their net profits as dividends to their shareholders. Dividend yield is the percentage of dividend paid by the company divided by current market price of the share. I will repeat the definition again. Dividend yield is the percentage of dividend paid by the company divided by current market price of the share. Generally, companies with a long history and well-established financial structures pay dividends. Most of the blue chip stocks pay dividends, but their market prices are too high. Because of that, dividend paid with respect to their price is very less. We get dividend yield somewhere around 1 to 2%. This is the same list we have seen in the last video. Return on equity is great for TCS, and this explains why it is trading at high premiums compared to the next 4. Interest coverage ratio is superb for all the companies. Wipro has the least interest coverage ratio of 23, but anything over 10 is more than enough to consider it as a good investment. Since these companies belong to the IT sector, EV by EBITDA values are higher. Dividend yields are around 1 to 2% as we talked about earlier. HCL Technologies is an exception here. It is paying a dividend yield of 3.32% at the current market price. It is an excellent choice to consider both growth perception as well as dividend also. We have learned about 8 fundamental parameters from the previous video and this video combined, and they are price to earnings or PE ratio, price to book or PB ratio, debt to equity ratio, current ratio, return on equity, interest coverage ratio, EV by EBITDA and dividend yield. These 8 parameters are more than enough to find a good investment in stock markets. That being said, there are many traps laid ready for newbies entering in the markets. Make sure you research well and if possible consult a research analyst or financial advisor before making any investments. I hope this video is informative. If you like the video, share it with your friends. Thank you, take care and goodbye.